In Chapter 11, we described the accounting and finance functions within business. We went through the accounting function, the financial accounting function, and management accounting. And now, we will conclude this chapter by sharing with you the treasury and tax function. So now, let's move on to discuss about the treasury first. For treasury management, it is the corporate handling of all financial matters, the generation of external and internal funds for business. So here, the keywords I highlight here is external and internal funds. The keyword is funds for business, and the management of currencies and cash flows and the complex strategies, policies, and procedures of corporate finance. So in brief, treasury management means the funds management of a business to see whether how can the company improve its cash flows, or manage the currency risk, or manage the debt and equity financing. All these issues or topics is about funds. So the key roles of treasury function, by concerning the key here, the funds, we have four key roles of treasury functions. First, working capital management. For working capital management, the treasury section will monitor the organization's cash balance and working capital to ensure that it never runs out of money. So I will explain to you what is working capital in the following slides, but to give you a brief concept, one of the key roles of treasury function is to manage its working capital. Second, cash management. It's quite simple and straightforward. The treasury function prepare of cash budgets and arrangements of overdrafts where necessary. So it helps to manage the cash well. If it expects there is any shortage or even overdraft, then it needs to prepare for, say, overdraft or any loan financing. Let's talk about financing. We just mentioned about the cash management and is highly related to financing. For financing, the treasury section will monitor the organization's investments and borrowings to ensure they gain as much investment income as possible and incur as little interest expense as possible. In other words, for financing, the Treasury Department need to think about how much of the financing are required for the company to operate, and to try to minimize the interest expense or interest incurred for the financing activities. At the same time, if the company has very strong cash flow with very good operation, so the operation can generate the cash inflow into the business or into the organizations, the treasury function need to think about how to optimize the use of the funds generated through the operation. For example, the cash balance can we invest in any existing business or activities, or to put into the bank, or to have a higher bank interest or higher investment income from the funds generated through the operation. So it's two way. One way is about the debt finance to see how to minimize the interest cost. On the other hand, if there's a positive cash flow, no debt, then the treasury need to think about how to optimize the investment income from the cash held in the bank accounts. And another key role of treasury function is foreign currency management. The treasury section will monitor foreign exchange rates and try to manage the organization's affairs so that it minimizes losses due to changes in foreign exchange rates. In other words, if a company needs to buy or purchase goods from any other foreign countries and need to pay foreign currency, treasury function need to think and need to advise how to manage this currency or foreign currency payment. On the other hand, if the company has customers outside of your country, say in a foreign country, and the billing, the invoice, is stated in the foreign currency terms, the treasury function needs to manage the receivables as well as the foreign currency received from the customer in order to minimize any foreign exchange loss. So first, let's talk about the working capital or the working capital management and cash management here. Working capital is the capital available for conducting the day-to-day operations of an organization, calculated as the excess of current assets over current liabilities. So here is CA and here is CL. So in general, the current assets should be larger than current liabilities is the working capital. If it's negative, that means the current liabilities is more than the current assets. Then it's a red signal or red flag should be raised for the organizations. And here the working capital is about the day-to-day operations of an organization. So it's all about the current assets and current liabilities. It's not about the long-term liabilities or any fixed assets here. We don't consider any fixed assets or long-term liabilities in the calculation of working capital. And the treasury function is responsible for deciding on an appropriate level of investment in working capital for the business. So in other words, working capital is your capital, your company's capital. It involves the shareholders' equity or shareholders' funds or from the bank's loans to have the working capital in your business. And the treasury function needs to step in on whether we should have higher working capital level or lower working capital level. And here is about the working capital, the calculation of working capital in the financial statements. We have inventory, we have trade receivables, we have cash. All these are current assets that we need to consider in the calculation of working capital. And also we have trade payables. In other words, the working capital is the difference between the total current assets and trade payables. The working capital balance here is the difference between current assets or total current assets and the trade payables. And for inventory, why we should have a higher or large balance of inventory? Because customers are more happy with it, because we can provide the goods or supply the goods to them immediately if we have the adequate inventory in the warehouse. But on the other hand, it's also not good to the company as well, because if we can keep the inventory at a small balance, it means we no need to have the holding cost or very low holding cost. We no need to have a big warehouse for keeping the stock. At the same time, we can also be benefited by lower risk or less risk of stock obsolescence, because once the inventory we keep in the warehouse, and after say 3 months, 6 months, the inventory get obsolete, we need to write down or we need to dispose of those inventory because they are already obsolete. We cannot sell them. And if we can keep the balance as small as possible, the risk of obsolescence will be lower as well. And next item under working capital or current assets is trade receivables. For trade receivables, if we can have a large balance of it, customers are happy. Why? Because we give them credits. They don't need to pay to us now. They can wait for a while, say 30 days or 60 days. They are more happy because they can keep their cash on their pocket or in their bank accounts. But to us, we try to minimize the trade receivables and the balance as small as possible, because first of all, it's good for the cash flows. Second, the doubtful debts or the bad debts will be lower as well, because if we give the credits to our customers, it's our risk that the customer cannot pay to us in 30 days or 60 days. But if we say the trading terms between our company and the customer is cash on delivery, that means we need to collect the cash from the customers before or even at the time when we deliver the goods to them. First of all, it helps to improve our cash flow on COD terms, the cash on delivery. Next, it also minimizes the risk of uncollectible debts, because if we give the customer a credit terms, there is a risk of uncollectible debts from our customers. But if we offered only the COD, the cash on delivery, we minimize the risk, because if the customer cannot pay to us, we no need to deliver the goods, or we know we can collect the goods back when we deliver to them. So next, trade payables. For trade payables, it benefits for us if we can keep the balance as large as possible, because it means that we have the credit terms to our supplier, and the supplier grant the credit terms to us. We no need to pay to them. Now we can say only to pay to them in 30 days or 60 days. We can preserve our own cash in our bank accounts. But if we minimize or our payable balance, the trade payable balance is small, that means we pay to our suppliers quite soon, say even for during delivery COD terms, we pay to our suppliers. Suppliers are more happy, and sometimes they can offer us discount as well, because we can pay to them quite in a short period of time. But it's not a must. So sometimes they offer discounts for early payments. Another item under working capital is cash. If we keep a large balance of cash, we can pay our creditors more sooner than before, or sooner than other competitors, because we have an adequate cash balance on hand. So creditors are more happy to see it. But if we hold the cash and then we invest the cash into other area or elsewhere, say even we put into the bank deposits or fixed deposits or any other short-term investment instruments, we can enjoy the investment return from those investments as well. So here we are more happy to see the return generated from the excess cash, so we can earn more profits for it. So here is the summary of the advantages why we should have a larger balance of each working capital element, say inventory, trade receivables, trade payables, and cash, and also why we should have smaller balance. And there's no right or wrong, because sometimes we need to consider whether a large balance is good for the company as a whole or small balance. So we need to have the trade-off between the large balance and small balance of each item. So after sharing with you the working capital management and the cash management as well, because in previous slide we talked two topics, then next we move to the third element in the roles of treasury, which is the financing. An organization may need additional funding to allow it to grow and invest in new projects. It's true, because for an organization, the funding generated from the operation may not be enough for them to invest in new projects or to expand. So in sometimes when there's a very good project or opportunities comes to the company need to consider how to raise the finance from external sources in order to grab the opportunities. And there are two main types of external finance: debt and equity. So for debt, involves borrowing cash from third party and promising to repay them at a later date, with interest payments on the amounts borrowed. The examples of that include bank loans, overdrafts, bonds, and debentures. So in other words, debt is from third party that we need to repay to them on an agreed date, as well as we need to pay interest to them on the agreed period of time as well. So that is an obligation. Okay, we have to pay back to the debt holder, no matter they are bank or the bonds holder or debentures holder. For equity, it involves selling a stake of the business in order to raise cash. Example include equity financing, includes sales of shares to new or existing shareholders. In other words, for equity, it's part of our ownership sold to third party. And for this, we can raise the money or raise the funds for the operations or for expansion. But the ownership structure changed. For that, there's no change in ownership structure because the bank or any other bondholders, they just put the money in the company and we need to repay to them at an agreed date. But for equity, no. In general, for like ordinary shares, we no need to repay them with an agreed date. We only need to pay dividends if the companies are making profits. And to see whether we can pay dividends, the company need to have follow through some of the local regulations and guidance to see whether the company is able to pay the dividends to the shareholders. So as a brief, we introduced debt and equity financing and what are the advantages for two different methods of financing. For debt financing, first of all, a debt is an obligation, so we need to pay interest. And for interest, the interest payment, they are allowable against tax. That means they are tax deductible items. When you work out the tax computation, tax is generally an acceptable item for for expense deduction in your tax computation, but it's not the same as for dividends, because for dividends, it's not tax acceptable as a deductible item. And next, the advantage of debt financing is no change in ownership of the organization. It's especially important for some family-owned business because they don't want to have a change in the ownership structure, and debt financing is more preferred in case there's no change of ownership in the organization. For that, one of the advantages is it tends to be cheaper to service than equity. We will go through this topic in the financial management course, because we need to discuss further why do we have lower servicing costs for debt. But in general, debts we only pay for the interest, and because the bank or any bondholders they prefer to have the security when they when they are lending money to any organization. So they would like to have the security before making the decision to lend the money to an organization, and it helps to them, or it protects them as well. So when the risk is lower or minimized, then they can offer a cheaper of financing to the organization. But it's not the same for equity, because for equity, in general, there's no security or collateral of any equity financing. So on the other hand, it needs to have higher return by providing the funds or money to an organization, no matter for expansion or for operation. And for advantages of equity financing, as said, interest payment is an obligation and dividend payment is not. So in the cash flow management or in the cash management, interest payment need to be considered in a very serious in a very serious attitude or manner, because if there's any default in paying your interest on time, that means your company will be in trouble, because the bondholders or the bank will come to your office and may ask for repayments for all the outstanding loans as well, because it is the default in interest payment is generally considered as the default event for any loan agreement. But dividend payment not, because dividend payment is once the company has the profits generated, then it pays the dividend to the shareholders. For debt financing, it usually involves security on the company's assets, but equity doesn't require. So from the shareholders' point of view, it is preferred because there's no asset of the no company's asset is pledged or as a security for any financing if equity financing is raised. And now let's move on to the foreign currency. It's also one of the key roles of treasury function. For any organizations or companies, they may have the borrowings in foreign currencies, or may have customers or suppliers who will pay and expect payment in a foreign currency. So once there is any foreign currency exposure, the treasury function needs to step in to manage it as well. And the Treasury Department will try to manage affairs to minimize the company's exposure to foreign exchange losses. That is, minimize the loss. So I will share with you one example in the following slides to explain how to what is the real case for foreign currency or foreign exchange management. Here is an example. Assume a British company buys goods costing $1 million from a US company on 1st of January, and the goods are due to be paid on 31st of March. So in other words, you have the goods, or you buy the goods right now, and the cost is $1 million, but you don't need to pay now. Okay, you are a British company, and you only need to pay for this $1 million by 3 months later on 31st of March. And the exchange rate right now, that is on 1st of January, is one British pound equal to $1.5. So the goods in terms of pounds, the British pound is 666,000 pounds, around these numbers. And what happened if the exchange rate changed, or if there is any movement in the foreign exchange rate? So say if the exchange rate changes to 1 British pound to $1.3, in other words, the US dollars is appreciated or strengthened against the British pounds, then the payment in terms of pounds will be increased from 666,000 British pounds to 769,000 pounds. In other words, the company will expose the foreign exchange rate risk in 3 months by around 100,000 pounds if this exchange rate occurs. This around 100,000 pounds. And the company would like to manage the risk. So say, for example, you go into the bank and would like to manage this risk by entering into a foreign exchange rate contract or foreign exchange contract at 1st of January to fix the rate of exchange at which it can buy $1 million at 31st of March. So remember, for the spot rate, that means on the 1st of January, the exchange rate between British pounds and US dollars is 1 British pound to 1.5 US dollar. And now it looks for a hedging or the risk management by entering the foreign exchange contract. And the contract is usually an agreement between a company and a financial institution, let's say a bank, that both sides is obliged to perform at the agreed date with agreed rates. So for example, is agreed to fix at US dollar 1.45 to what 1 British pound equal to, say, just an example. So it can minimize the risk because it can exchange at a rate that is predetermined. The company no need to worry about whether the British pound will be depreciated against the US dollars. But it's an obligation. Remember, it's an obligation. So if it is more beneficial to the company when the exchange rate, say, movement happened, it cannot default because it's an obligation for both sides to execute the agreement. So tax. Here we would like to explain to you some key concepts about tax under finance department or the accounting function. The directors of a company have a duty to their shareholders to maximize post-tax profits. We mentioned about post-tax profits because if we have positive on post-tax profits, it means that the company can distribute the dividends if it can satisfy all local regulations and requirements. So the purpose is to maximize the post-tax profits from the shareholders' point of view. Because they are available for them for distribution as dividends to them. So there's a duty, or they have a duty to arrange the company's affairs to avoid taxes as far as possible. They means the finance department or the finance director. In this case, we can consider the treasury have a duty to arrange the company's affairs to avoid taxes as far as possible. Because not in many organizations, for example, like some small SME, what we call small and medium-sized enterprises, they don't have a tax department, for example. Sometimes the treasury department is also responsible for the tax issue as well. And here, the concern from the shareholders' point of view is the company's affair try to avoid taxes as far as possible. But be careful about this word, avoid. We will explain to you later why you need to be a bit careful on using avoid taxes. Because some dishonest reporting exists in the world. Dishonest reporting to the tax authorities, for example, declaring less income than actually earned, would be tax evasion, and it is a criminal offense. Then we have different terms or terminology here. First, tax mitigation. It's a new term introduced because in the past, we generally describe as tax evasion and tax avoidance. But here, we would like to explain there's some differences between them, and new terms also introduced by the parliament in some countries, say tax mitigation. Tax mitigation means a conduct that reduces tax liabilities is legal. Okay, first of all, it's legal without frustrating the intentions of the parliament. In other words, tax mitigation is the legal way to do it, and also it doesn't frustrate or it doesn't violate the intentions of the parliament for the legislation of respective tax rules. But for tax avoidance, it's a bit different. It is the legal use of the tax regime to one's own advantage in order to reduce the amount of tax payable by means that are within the law. But tax avoidance or tax avoidance schemes are designed to defeat the intentions of Parliament. In other words, yes, it is legal to have the tax avoidance, but the tax avoidance schemes are designed to defeat the intentions of Parliament. In other words, it is not ethical to do it. Even though it is legal, but it's not ethical because you designed to defeat the intention of Parliament. So once the tax avoidance schemes appeared in the society or in the business and community, the Parliament will have a serious considerations by enacting another tax law in order to in order to defeat these tax avoidance schemes. And for tax evasion, it's quite straightforward. It is the use of illegal means to reduce one's tax liability. For example, by deliberately misrepresenting the true state of your affairs to the tax authority. So it's quite straightforward by tax evasion. It is just illegal. So now is the in-class question time. We have 2 questions here. The first question is about the working capital management. Here, it describes conservative managers will have a policy of holding a large working capital balance, while aggressive management will hold a low working capital balance. Which of the following is a consequence of an aggressive management policy? So we focus on aggressive management policy, which hold low working capital balance. Low working capital balance means low account receivables, low inventory, low cash, and high payables balance. So which one of the statement here is correctly describe the consequence of an aggressive management policy? Whether A, increased debts, bad and doubtful debts, or B, increased credit periods attract more customers, or C, increased inventory obsolescence, or D, increased risk of inventory outages. So which one is correct? And next question is about ACCA plc. It's about financing. It needs to raise £50 million to launch a new product, and it hopes the new product will be a success. So raise the finance for product launch, but the returns are highly uncertain. So here is one assumption. The returns are not sure, it's highly uncertain, with a 30% chance that the launch will be a failure. So it's a chance for failure. What's the chance? It's 30%. The product is expected to sell for around 5 years. So the project is only lasts for 5 years time. And it is currently trying to decide whether the launch should be financed through using a 5-year bank loan, an option, or through raising equity. So there's one option is bank loan, and another option is equity financing. So which of the following statements is correct? A, equity will be cheaper as dividends are allowable against tax. B, AHG should choose equity due to the risky nature of the project. C, equity should be chosen as AHG needs a permanent increase in its finance. And D, debt usually does not require security, meaning it may be easier for AHG to raise. So which one is correct? Remember the advantage of debt financing and advantage of equity financing that we described before. So here, based on our discussion in this class, you can choose the best answer or the most appropriate answer here.